Most people enter the stock market with one big dream: buy something cheap, wait patiently, and one day watch it turn into a fortune. It sounds logical. It feels safe. It even feels intelligent. But William O'Neill, the founder of Investors Business Daily and one of the most influential growth investors of the modern era, argues that this instinct is exactly what keeps many investors stuck. Because in the stock market, what feels comfortable is often dangerous. We want to buy stocks after they fall because they look cheap. We want to hold losing positions because we hope they will come back. We want to believe a famous company must be a good investment simply because we recognize the name. But O'Neill's message in How to Make Money in Stocks is direct, uncomfortable, and powerful. The best stocks usually do not look cheap before they become huge winners. They often look expensive. They are already moving higher. Their earnings are accelerating. Big institutions are quietly buying them. Their industries are strong. Their charts are forming patterns that have repeated for decades. In other words, O'Neill teaches you not to hunt for the weakest stocks at discount prices, but to identify the strongest companies before they make their biggest moves. This book is not about day trading. It is not classic value investing, and it is not about randomly chasing hot tips. It is a disciplined system for finding great growth stocks, managing risk, and understanding when the market itself is working for you, or against you. At the center of the book is O'Neill's famous framework, CAN SLIM. Each letter stands for one major trait that many of history's biggest stock market winners had before they exploded in price. Let's break it down. The big idea: buy strength, not weakness. The most surprising idea in this book is also the one that goes most against human nature. O'Neill says you should buy stocks when they are moving up, not when they are collapsing. That sounds strange at first. Most people think, if a stock was $100 and now it is $50, it must be a bargain. But O'Neill would ask a different question. Why is it falling? A stock that keeps dropping may be cheap for a reason. Maybe earnings are slowing. Maybe institutions are selling. Maybe the company's best growth days are behind it. Maybe the entire market is weakening. A low price alone does not make a stock attractive. Instead, O'Neill looks for stocks showing strength, stocks approaching new highs, stocks with powerful earnings growth, stocks with rising demand, stocks that are leading their industries, not lagging behind them. This is the emotional challenge of the book. To make money in great growth stocks, you often have to do the opposite of what feels natural. You buy quality when it is proving itself. You add only after your position is working. You cut losses quickly when you are wrong. And you stop treating the stock market like a place where hope is a strategy. Why charts matter. O'Neill believed that stock charts reveal something extremely important: human behavior. Markets change. Companies change. Technology changes. But fear, greed, hope, panic, and crowd psychology do not change very much. That is why certain chart patterns appear again and again across different decades. According to O'Neill, the same basic patterns that appeared in the great winners of the past can still help investors identify future leaders. A chart is not magic. It does not predict the future perfectly, but it shows the battle between supply and demand. When a stock rises on strong volume, it often means big buyers are stepping in. When it falls hard on heavy volume, it may mean institutions are getting out. And because large institutions control so much money, their buying and selling can shape the entire movement of a stock. So for O'Neill, charts are not decorations. They are evidence. They help you answer a critical question. Is this stock being accumulated by serious buyers, or is it being quietly abandoned? The cup with handle pattern. One of the most famous ideas from How to Make Money in Stocks is the cup with handle pattern. Imagine a stock that has already gone up strongly. Then, instead of continuing forever, it pulls back. It corrects. It shakes out weaker investors. After that, it stabilizes and slowly climbs again. On a chart, this can look like a rounded cup. Then, near the old high, the stock drifts down slightly again. This small dip forms the handle. That handle is important because it can represent the final shakeout before a new breakout. In simple terms, the pattern tells a story. A strong stock rises. It pauses and corrects. Weak holders leave. Stronger buyers return. Then the stock prepares for its next move. O'Neill's key lesson is that you do not just buy any stock because it has a good story. You wait for the right setup. The cup with handle is one example of a setup where the stock has already proven strength, gone through a healthy correction, and may be ready to break out again. This is the difference between chasing and timing. Chasing means buying because you are excited. Timing means waiting for strength, structure, and confirmation. Can Slim, the 7 traits of big winners. The heart of the book is the Can Slim framework. O'Neill studied many of the greatest stock market winners and found that before their biggest price moves, they often shared 7 traits. C. Current quarterly earnings. The first trait is strong current earnings growth. O'Neill wants to know whether the company's most recent quarterly earnings per share are significantly higher than the same quarter 1 year earlier. This matters because big stock moves are usually driven by big business improvements. A company that is growing earnings quickly is proving that demand for its products or services is rising. It is not just promising growth, it is showing growth in the numbers. For O'Neill, small growth is not enough. A 10% increase may sound fine, but the biggest winners often show much stronger acceleration. He preferred companies with earnings growth of at least 25% and often much more. The practical lesson is simple. Do not fall in love with stories before checking the numbers. A great growth stock should have real growth behind it. A. Annual earnings growth. One good quarter can happen by accident. That is why O'Neill also looks for strong annual earnings growth over multiple years. A true leader is not just having one lucky moment. It has a track record. It has consistency. It has momentum. This helps separate companies with real long-term strength from companies that only had a temporary spike. When current earnings and annual earnings both look strong, the picture becomes more convincing. You are no longer just looking at a short-term surprise. You are looking at a business that may be entering a powerful growth phase. N. New products, new management, new highs. The N in Can Slim stands for something new. A new product, a new service, a new business model, a new management team, a new industry trend, or even a stock reaching a new price high. This is one of the most important ideas in the book. Huge stock market winners usually have a catalyst. They are not rising for no reason. Something has changed. Maybe the company launched a product that reshapes its market. Maybe a new CEO has transformed the business. Maybe a new technology is creating a massive wave of demand. O'Neill's point is that big stock moves often begin when a company enters a new chapter. This is also where many investors make a mistake. They see a stock hitting new highs and think, it is too late. But O'Neill argues that new highs can actually be a sign of strength, not danger, if the company also has the earnings, leadership, and institutional demand to support the move. The market often rewards companies that are creating the future, not companies that merely look cheap because their best days are behind them. S. Supply and demand stocks move because of supply and demand. If a company has a smaller number of shares available and demand rises sharply, the stock can move fast. If a company has billions of shares outstanding, it usually takes much more buying pressure to move the price dramatically. This does not mean smaller companies are always better. Smaller stocks can be more volatile and risky. But O'Neill wants investors to understand that share supply matters. He also pays attention to whether companies are buying back their own shares. Buybacks can reduce supply and may signal that management believes the stock is valuable. The deeper lesson is this: a great company is not enough. You also need strong demand for the stock itself, and the most powerful demand usually comes from big institutions. L. Leader or laggard. O'Neill is very clear on this point. Buy leaders, not laggards. A leader is not always the biggest company or the most famous brand. A true market leader is the company showing superior earnings growth, stronger sales, better margins, higher return on equity, and stronger price performance compared with other stocks. This is where many investors get trapped. They buy the cheap stock in a strong industry because they think it will catch up. But O'Neill prefers the stock that is already leading. Why? Because strength often attracts more strength. The best stocks usually outperform before they become obvious to everyone. They show relative strength. They move better than the market. They resist weakness. They recover faster. O'Neill's system asks you to stop looking for sympathy plays and start looking for real champions. I. Institutional sponsorship. Large institutions are the fuel behind major stock moves. Mutual funds, pension funds, hedge funds, insurance companies, and other big investors have enough capital to push stocks much higher when they build positions. O'Neill does not necessarily want a stock owned by every institution already. If everyone already owns it, there may be fewer new buyers left. Instead, he looks for quality institutional sponsorship that is increasing. The ideal situation is a stock that has some strong institutional support, but still has room for more institutions to discover it. This creates a powerful demand runway. For individual investors, this is a useful reminder. You do not need to be bigger than the institutions, but you do want to recognize when they may be quietly moving into a stock. M. Market direction. The final letter may be the most important of all. M stands for market direction. O'Neill argues that even if you pick a great company, you can still lose money if the general market is in a major downtrend. In weak markets, most stocks tend to fall together. Even strong companies can get pulled down when fear takes over. This is why O'Neill pays close attention to major indexes like the Nasdaq and S&P 500. The question is not just, is this a great stock? The question is also, is the overall market environment healthy enough for growth stocks to work? This is a huge lesson for beginners. Many investors focus only on the stock and ignore the market. But the market is like the weather. Even the best pilot respects the storm. The real discipline: risk management. A major part of O'Neill's system is not just finding winners, it is surviving your losers. He teaches investors to cut losses quickly instead of letting small mistakes turn into disasters. This is emotionally difficult because selling at a loss feels like admitting failure. But in reality, cutting a loss is often a sign of discipline. You do not need to be right all the time to make money in stocks. You need a system where your losses are controlled and your winners have room to grow. That is the mindset shift. Amateurs try to avoid being wrong. Professionals accept that they will be wrong sometimes, then manage the damage. This is one of the most practical lessons in the book. Never let your ego manage your portfolio. Use rules, use charts, use earnings, use market direction. And when the evidence changes, be willing to change your mind. How to apply O'Neill's system. Here is a simple way to turn the book into action. First, look for companies with strong current quarterly earnings growth. Do not start with opinions. Start with numbers. Second, confirm that annual earnings have also been growing. You want consistency, not one lucky quarter. Third, look for something new: a new product, a new trend, a new management team, or a stock breaking into new high ground. Fourth, study supply and demand. Is the stock rising on strong volume? Are buyers showing real interest? Fifth, choose leaders. Avoid weak stocks just because they look cheap. Sixth, check institutional sponsorship. You want evidence that serious investors are involved, but not so much ownership that the opportunity is already overcrowded. Finally, respect the overall market. If the market is unhealthy, be defensive. Great investing is not just about offense. It is also about knowing when to protect your capital. This is not a system for gambling. It is a system for stacking probabilities in your favor. The main lesson: How to Make Money in Stocks, is really a book about discipline. It teaches you to stop investing based on hope, rumors, emotions, and the illusion of cheapness. Instead, O'Neill shows you how to look for measurable strength: strong earnings, strong sales, strong price action, strong demand, strong leadership, strong market conditions. The book's message is simple but not easy. Do not buy weakness just because it feels safe. Do not hold losers just because you want to be right. Do not ignore the market because you love a company's story. And do not confuse a low price with a good opportunity. The greatest stock market winners often look strong before they become legendary. Your job is not to predict the future perfectly. Your job is to recognize strength early, manage risk carefully, and let the evidence guide your decisions. Final takeaway: William O'Neill's system is powerful because it combines two things most investors keep separate: business fundamentals and market behavior. He cares about earnings, growth, innovation, and leadership. but he also cares about charts, price action, volume, and market direction. That balance is what makes Can Slim so memorable. It reminds us that investing is not just about finding good companies. It is about finding strong companies at the right time, in the right market, with the right risk control. So the next time you look at a stock, do not just ask, is it cheap? Ask better questions. Is the company growing fast? Is it a leader? Is something new driving demand? Are institutions buying? Is the chart showing strength? Is the market supporting the move? And most importantly, if I am wrong, do I have the discipline to get out? Because in the stock market, knowledge matters, but discipline is what keeps you alive long enough to benefit from it. If this summary helped you see investing more clearly, make sure to like the video, subscribe to the Lazy Capybaras, and save this lesson for the next time the market tries to tempt you into buying weakness instead of real strength.